So by now we have understood the concept of support and resistance levels. We have learned that support is nothing else but a price point from where the stock price picks up, and resistance is nothing else but a price level from where the stock price falls down. Here we are going to talk a bit more about risk reward ratios with respect to levels. Now I suppose that you by now realize if we have a chart like this, now if I am marking a resistance level out here, if this was an earlier point of resistance and this was an earlier point of support, at any later point of time, once again if the price is testing out the same level, I would kind of consider that the price could manage to find a rejection or a resistance out over here. Howsoever, if the buyers are capable of breaking above this particular level now, till where do I expect the price to head up to? That is a question. The answer is pretty simple. If this was an earlier resistance level, and post that if this was the next level that got formed as far as this particular stock is concerned, the next time this level is getting taken out, I would actually expect the price to easily reach the earlier level. So what I am simply trying to convey is that once one particular level is getting taken out, we can anticipate that the price could manage to head up to the next significant level. So in this particular case, this looks like the next significant level for the stock. So if this resistance level is getting broken or the price is managing to pierce above the levels, we can anticipate that the price could head up till this particular point. So realize for yourself, if one level is getting taken out, we expect the price to move towards the next significant level. So let it be the nearby resistance or the nearby support. Now let's try to understand the scenario with another example. So here also I have marked some levels. So let's assume this to be the price of any particular stock. So it seems that it's finding a support out over here. Then later after that the price drops down, and then the price manages to find a support over here. For a very small duration of time, price travels within this range, and I consider this to be a resistance point. Now once the price once again breaks this particular resistance point, till where can I expect the price to move? The very simple answer is, if this resistance level is getting taken out again, I could easily anticipate the price to head up to the next significant level. So in this particular case, let's assume that only till here the price has happened and we don't know this particular region, what is going to happen. So if this resistance is getting taken out, I can easily anticipate the price could manage to move towards the next level, which lies out over here. Now the price is finding a resistance over here, which was the old support level. So we have learned this concept earlier, where the old support starts to act as a new resistance once it gets broken. And let's see, so now in this space, maybe for some time the price is traveling within a range. Now if the price is maybe trying to break above this resistance level now, I could expect the price to head up higher, and the next significant level, as you see there is some sort of a level out here. I can expect after this level getting taken out, the price could potentially face some sort of a rejection from this resistance level. Now once again, if it is undergoing a retest, this old resistance level can tend to act as your new support, as we see over here. So these are all the demonstrative examples. I would also show you the same in some live charts right now, and just realize for yourself, understanding and marking support and resistance levels is not as easy as it looks like. It takes you some time to get comfortable with it, but it is not really tough to do also. Now let me just show you two separate scenarios, and let's try to identify the difference between the two. Okay, so consider this to be scenario A and consider this to be scenario B. Okay, so in both the scenarios, let's assume this to be the same stock on a same day, but the charts look a bit different. So this is price point 100 and this is price level 100, price point or price level. Now let's say in this particular case the price is finding some sort of a support at point 95, and in the second case the price is finding some sort of a support at 95 once again. Okay, here if the resistance level lies at 96, in the second scenario the resistance level lies at 98. Now if I ask you a question, if the price is managing to break above this particular resistance, so this is what I am considering to be the resistance level, So in both scenarios, let's say the resistance level is at 98. So my simple question to you is, if this resistance level at 96 and 98 is being taken out, till where could you expect or till where could you anticipate the price to head up to? Now, if you have been able to follow whatever has been discussed so far, then it's pretty sure that you would be able to answer. In scenario A, you would be anticipating the price to move from 96 to 100 because that is the next significant resistance level. And in scenario B, you would be anticipating the price to move from 98 to 100 because that is the next significant level as far as scenario B is personally concerned. Now, let me ask you this question. So both are trades based on breakouts where the price is actually going to come out of a particular range. In this particular scenario A, the range is between 95 and 96, just a 1 rupee range. And in the scenario B, the range is between 98 to 95, that is like a 3 rupee range. So which would be a better scenario to take? Which breakout would be a better opportunity out for you? So friends, some of you must already be familiar with the concept of a stop loss. Okay. In the markets, stop loss is nothing else but a tool that we actually use to limit our losses. I'll give you a scenario. So let's say that I'm purchasing a stock at 100 with the perception that the price is eventually managing to go to 120. Now, there could be somebody else who buys at 100 with the perception that the price is going to go to 105. That is, the second person would be expecting the price to increase by 5 rupee, while the first person would be expecting the price to increase from 100 to 120, that is by 20 rupee. Now just think about a case where you're buying at 100 and you are actually holding on to the stock. So I'm assuming a trade where you're holding maybe for 1 week or even maybe for 1 day duration. Okay, I'm talking about trading, not about investing. Now, if you are someone who thinks, okay, I will buy this as 100 and I'll be comfortable in waiting for the price to move to 120 and I really don't care if the price is coming down to 50 or 40 or 30, then that is not the right approach. Why? Because when you're buying at 100 with a perception to sell off at 105, the maximum reward that you're checking out for in that particular case is just 5 rupee. Now it really doesn't make any sense for you to look out for a reward of 5 rupee by taking a risk of, let's say, 20 rupee or even 10 rupee. In simple words, it doesn't make sense for you to look out for a reward that is actually lesser than the risk that you're taking alongside with it. With setups which has a 50-50 accuracy maybe. Now, let's look at these two scenarios. Okay, if I'm someone who knows the next level for the stock is from 96 to 100, the potential reward I could actually check out for would be 4 rupee. Now, if I'm someone who has a feeling the next possible move would be from 98 to 100, then the potential reward I'm checking out for is 2 rupee. So I'm not kind of conveying to you that the price can't manage to move above 100 or move above 100 in this case. There could be scenarios where first price reaches here and then manages to pick up. What I'm conveying is the first potential profit point. So in this scenario, I consider it to be 4 rupee move from 96 to 100, and in this scenario from 98 to 100, that is 2 rupee move. Now, a common question that you would ask is, how do I set a stop loss, or where would I keep my stop loss? So we understand for ourselves that stop loss is nothing else but a tool that we actually use to limit ourselves from extreme losses. The obvious question could be where to keep the stop loss. The most simple answer I can actually give you is keep a stop loss where you understand for yourself where your view goes wrong. Let's consider the scenario of you running a business. Would you think that you'll need to go to the extent of bankruptcy to realize that your business model wasn't right? Or would you think that you will actually hold on to an extent where the company goes to negative balance for you to realize, okay, you were not operating in the right methodologies? Just realize for yourself, there is always an opportunity for you to conclude the fact that what you're doing is not right, and maybe you can think about bringing in some sort of an improvisation to save up your business. Same way, in the case of markets, many a times people think in the stock markets sticking with the system is being right all the times, but that's not the answer. So right now we are talking about directional trading systems based on breakouts. So especially when you're trading directional, there is a high chance that is going to be just 50 or 40% of the times that you trade are going to end up as winners. The rest 60% are going to be losers. Now if that is the case, if more than half of your trades are going to fail, then what do you think? So how do you kind of actually think you can still end up being profitable? It is just because of the fact that you need to exactly understand when to cut short your losing positions, and that is where we need the stop loss. I'll kind of give you one example. In the first scenario, we understand that if this is the resistance level and if this is the nearby support just beneath that, if we are thinking about checking out for a long side breakout opportunity, if the price manages to pick up above this level, and if at any later point of time if the price manages to drop down once again beneath these levels, we would more than realize for ourselves our view has gone wrong. That is something that we initially had as a bullish perspective. If the price manages to break below this particular support, we realize for ourselves, okay, our view has eventually turned out to be wrong. Then we should be exiting out from that position. That is, we should be setting our stop loss. So usually not exactly at 95, you give a buffer based on the levels, but let's assume it to be at 94.5, or let's assume it to be at 95 itself for ease of explanation. So I'll consider to set my stop loss at 95 in this particular case, and if the price manages to come below 95 at any point of time, I need to figure out for myself my view has turned out to be wrong and I need to exit out from the trade. So in simple words, the reason why we keep our stop loss just beneath the nearby support is because of the fact that if a support level is getting broken based out of a breakout, whatever we have learned about levels, we are just thinking that okay, support got broken, now there is a chance that price could manage to move towards the next significant level that is beneath this particular support. Just like we thought after a resistance level getting broken, we anticipated the price to move towards 100 levels, which is the nearby resistance. Same way, if the support is getting taken out, we expect okay, price can actually manage to move towards the next significant level on the downside. That is why we kept our stop loss at that point where we would realize for ourselves our view would turn to be wrong. Now let's talk about the scenario of these resistance at 98 and the support at 95. Now if you are someone who is anticipating some sort of a bullish move to be coming in, you would actually check out for a breakout opportunity based on the 98 levels getting broken. Once again, we are expecting the price to move towards 100, that is 2 rupee move, but in this scenario I would have to set my stop loss below 95 levels, that is almost like a 3 rupee stop loss. Now if you ask me what is the reason or what is the rationale why I keep my stop loss below 95, the answer is pretty simple. If at all the price can manage to break below 95, then there is a tendency of a further downside fall to be coming in. So I keep my stop loss out over here because I just realized or figure out for myself, if price manages to break below this, that could be the start of a potential new downside move towards the next significant level. So in simple words, we keep our stop loss at a point where we realize our view turns to be wrong or turns to be exactly the opposite. And in fact, so if somebody is actually on a long side position and once the stop loss actually gets triggered, if the confluences are factoring in, he or she may even consider thinking about flipping his positions. That is the fact that if he was initially on the long side, if the price kind of triggers a stop loss, if he feels okay, this is a significant level that is getting taken out, he can turn to the short side on his positions.